so it's all right. It's all good. I had Crabtree in my fantasy football. He's really good. Yeah. It's about time, right? How'd you become a fan? I mean, okay. Right. Right. It's funny, right? Right. Right. It does, right?
Good evening, everyone. And it's nice to see such a good crowd here in spite of the terrible weather outside. I hope you didn't have any trouble coming. It is my great pleasure to announce the executive lecture series here and invite Dan Charleston to come and speak to us about the high yield bond market. Let me tell you a little bit about Mr. Charleston. First of all, he's a friend of mine, so that I would like to say with some pride. He graduated from Keene University, and so, as a profile, he shares a lot in common with us. And he worked his way from the bottom of the financial sector all the way up to the top. A couple of career highlights are that from 2001 to 2008, he was at Stonegate Capital Market, which is a very large investment house in New York, in downtown New York, and reached the position of Chief Investment Officer. And beat a lot of Harvard graduates along the way to get there. And then after that, he became an entrepreneur and started his own company called Global Credit Advisors, LLC, which he is still an advisor to and currently is the CEO of his own firm, Dan Charleston, DJC Capital Holdings, LLC. So what I wanted to emphasize is that Dan has a career path that all of us can aspire to and that all of us can reach. And therefore, I have asked him to speak about two things. One is to talk to us about his career trajectory and along the way, give us some sort of advice on how our students can do something similar with their lives. The second thing is to talk to us about the high yield bond market and what it represents and its intricacies a little bit. So the structure is basically as follows. Dan will speak to us between 40 and 45 minutes. And then after that, so please hold your questions till the end. This event is not only being attended by all of you, but it is being live streamed to about 15,000 people. So therefore, I would request that when you are ready for the Q&A session that you step up. There are 2 live mics here. If you spoke clearly into the mic, then the people who are following this on the internet can also listen to your questions. So without further ado, I give you Dan Charleston.
Thank you. Thank you, Raz. I can call you Raza because we are friends. But I'm thankful to be here at William Patterson. As Raza mentioned, I graduated from Keene University, maybe a 25-minute car ride from here. And I think we have a lot in common when I look across the audience here. I was the youngest out of 6 in my family, the first one to go to college. And I know the demographics of Keene, there's a lot of first-time students in their family that are working hard and trying to get ahead, not only in their college academic pursuits, but also in the business world, which at some point, hopefully it's not a 5-year program here, but at some point you'll move forward into the business world and find endeavors that you really have passion about. And that's the first thing that I really want to talk about is passion. And I'll get to the meat of the discussion about the high yield market, but really you need passion to continue to learn. Very important to keep passion in your studies, passion in whatever you pursue, not only in your studies, but in life. So let's talk a little bit about, a little bit more in depth about my background. I started very humbly, took my first job out of college for a company called Morgan Guaranty Trust. And I remember receiving the phone call, and they told me you're going to make $287 a week, and I raised my hand, I'm in. Now, this was back in 1983, and I had a car payment, and just moved into an apartment, was soon to be married, and I really jumped on it. I didn't even hesitate to take that opportunity, and clearly had lots of interviews, but $287 just seemed like so much money back in the early 80s. And my brother actually gave me good advice. He said, take that job and continue to work hard, pound the pavement, as they call it on Wall Street, and continue to move forward. That's exactly what I did. So when I started at Morgan Guaranty, I worked about 1.5 years in a small operations department called dividend reinvestment. A year later, I updated my resume and moved on to a money transfer division within JP Morgan, and then succeeded to go on to one other operations, or what we call back office environment in JP Morgan Securities, where I got a little bit of taste of what investments are all about. And I had interactions with what's known as floor traders for the commercial bank. And I was doing a lot of accounting work. So as soon as I saw that, something lit and said, you know what, this is really where I want to go with my life. 2 or 3 years kind of pounding the pavement, and then I found something, and that's all I needed. So from that point on, I was very aggressive and found an opportunity to work with a portfolio manager who ran a government bond fund and a mortgage-backed securities fund within the fixed income universe. So I worked there under his mentorship for a couple of years, and this was in the late 80s. And back in the late 80s, the word high yield wasn't even on anyone's radar screen. So if you're familiar with the equity markets and the debt markets, high yield was the stepchild. And when they talk about it as junk bonds and distressed securities, and it's morphed into like synthetic securities and credit default swaps, and it's gone this whole different direction. But when I started, the acronym junk bonds was really looked and frowned upon. So in the late 80s, there was an opportunity at J&W Seligman, and I took that opportunity to become what's known as the portfolio manager of a very small fund. So small, in fact, it was well below the radar screen, wasn't making any money for J&W Seligman. It was like $35 million. It sounds like a lot, but in order to gain scale, you need more assets to manage under management to make it profitable for the business. So I took that opportunity. Again, I think I was 28 years old, and didn't really have my feet wet in terms of portfolio management, but continued to work hard. Learned everything I could about the business, the investments. I remember taking a lot of subway train rides up and down Wall Street, Midtown to downtown, listening to companies come in and present and look for capital, raise capital to push their own respective businesses. So I did that. So from 35 million in the late 80s to about 1995, I got to about 200 million. Now, it wasn't really a big Herculean jump, but it was enough to get on the radar screen of the partners. And from that point, I was able to build a team, hired 1 or 2 financial analysts, and from that point on, we got some recognition because the fund became the #1 fund in the country out of about 150. So all of a sudden, there's some name recognition, and I was able to launch that name recognition into a much larger, successful business profile for J&W Seligman. So that's kind of how I got my start, and that went from 200 million to about $4 billion, mostly on what we call the buy side, right? So if you're on the buy side, you're managing other people's money. And so I ran like $2 billion in what's known as a mutual fund, which is distributed and sold to like mom and dads, retail investors. And then I also managed about $1.5 billion for corporations, endowments, pension funds, insurance companies, and the like. So had an institutional presence. So, but along the way, I mean, this is really fast forwarding a lot. There's a lot of work that goes into that. I lived in East Brunswick and these commutes from East Brunswick. I thought the commute to Wayne was pretty difficult tonight. But from East Brunswick to Midtown and downtown Manhattan, it takes about an hour and a half easily, door to door. So I'm spending 3 hours a day commuting back and forth. So if you have any aspirations to work in Wall Street, expect long commutes and very, very long hours. I was getting up at 4:45 and getting home at 6:45. So it's a 12-hour day at the very least. So expect long hours, and it will pay off. So let's get into a little bit more meat of the presentation. So what I'm going to do, I'm going to skip slide 1, slide 2, and go right to slide 3. And we're going to hear a little clip from Carl Icahn. Let's see if I can get this to play for you. Carl Icahn. Is everyone familiar with Carl Icahn? Raise a hand. Yes, a couple, handful. Okay. So he's going to give a little 2 minutes commentary on high yield.
Low interest rate environment. How do you see this? What implications does it mean to the economy?
Well, the Fed is really, in my opinion, holding the market up. I mean, we're long and we keep a big hedge on. Day like this, we make money, but it is concerning that the Fed turned this market around here because it sort of let it be known that the Fed funds rate isn't going to be raised in March. So you have to be concerned. I am concerned about the high yield market. I think that's in a major bubble, but I won't say to short it tomorrow, even though we have a short position on it to some extent. But what we do is a very arcane kind of derivative where we do the CDS. We buy the CDS on it. I'm going to explain it on my Twitter account one of these days. I'm going to try to write something on it. It's really interesting what we do on that. But it would take you more than half an hour to get into what we do with these derivatives. It's really saying the credit spread is way too narrow. We did this in 07. I did it in 07 because I was worried. It was like this in 07, and sometimes you hit big, and in 07 and 08, see, that's what happens. In 08, on a couple of $100 million investment, believe it or not, we made $1.4 billion because the spread widens, and when it widens, you make a lot of money.
But does it worry you to be in the credit derivatives market in high yield at a time where there's a liquidity crunch? Can't everybody find the exit door?
No, that's why we're on the other side of it. In other words, if they can't find the door, we come out. Pretty good. We're out of the fire, so to speak. I really think it's a bubble, but I'm not going to tell you to get nervous today. I think with the Fed doing what they're doing, nobody can pick what the market's going to do tomorrow, next week, even next month, and maybe even 6 months. There are too many variables for the human brain to do it. It's wasted occupation. A lot of people write these erudite papers on it, but it's very hard to. You can pick it on a long-term basis and be right, or you could find a no-brainer. This is what I look for with the risk rewards.
You look for a no-brainer?
The risk rewards major in your favor. I think there's a no-brainer. Long-term, the high-yield market is in a bubble, but when it's going to burst, it costs you money to do what I'm saying. It costs you money while you're waiting, so it's not for a lot of people.
All right, Mr. Carl Icahn. Let's get this out of here.
Close it out.
Wow. Okay. So,
Excuse me, I
oh,
think we have
you
to.
turned it back on.
But I won't say to short it tomorrow. This market.
There you go. We don't want to hear him again, do we?
No.
Okay. So Carl Icahn, that's spoken like a true portfolio manager. You never really tell your competition what exactly you're doing, right? He said a lot of mumbo, shorting the market through CDS. We have time, but we're losing money. Which way is he going? We really don't know. So very interesting. He talked about Fed policy just a little bit, right? So the way it really works, the asset class is kind of mixed between equity and treasuries, right, in terms of correlation. So currently, we've got very tight spreads, which means it's more closely correlated to what the Fed is going to do and what interest rates are going to do. Back in the late 80s, when yields, absolute yields for high yield, like 10, 11%, it was trading more in tune to an equity investment, the equity component. So we have these cycles in high yield, and he's talking about, when's the next crash? It's on a bubble. When's it going to happen? I mean, nobody really knows in terms of time or timing, but I can tell you this. From 1980 to 2000, currently, year to date, 2016, there's only been 5 periods in which the high yield market has produced a negative return. I mean, that's pretty darn good track record across any asset class. So, we'll go through a chart here, and I'll skip right to it. There's maybe 5 periods. Let's just go right to the spreads. Let's go here. So here we go. This chart really talks about, and you can see this directionally is going from left side of your screen down to the south, right? That's a good thing, because that means spreads are tightening over time. So this is from 87 through 2015, and there's a few periods, so I can highlight this here. So right here, 89 through 91, that's a financial S&L crisis, and then spreads recovered. And then a little blip here in 94 was a rise in interest rates through the Fed. They raised interest rates 6 times consecutively that year, so keep that in mind when we get back to Fed policy. And 99, of course, you see this whole rise here. That's kind of the telecommunications tech bubble, which culminated, I guess, in 2000, Y2K. And then we had another spread tightening. And of course, this whole period here is the formation of the subprime mortgage and the real estate market that got really overheated. And it ended up, of course, with this significant spike and widening through Lehman and the Bear Stearns collapse, and of course some famous movies out there talking about this, and then a rapid decline in spreads due to monetary policy from the Fed, Ben Bernanke, called more like quantitative easing. You hear that term out there a lot. And so what we have here is the 5th period of time where high yield underperformed, had negative returns. This is the collapse in the commodity markets, the oil markets. If you remember, oil was at $100, and your commute to Wayne was a lot more expensive. Gas was at close to $4 a gallon here in the state of New Jersey. It's down to like $2. Of course, we just got a nice 23-cent tax from our politicians. But nonetheless, so this was the collapse in the commodity markets. And we have another recovery here, which was the current market. So and along this, you could see we've ranged from as high as 20% in high yield down to 6.5. And another way we talk about this is through spreads, and spreads are at 500 plus basis points. The average over 20 years, you can see here, is like 600 basis points, and this is off of treasuries. Now, treasuries and the fixed income are what we'll call them riskless, because they're backed by the full faith and printing power of the U.S. government. So this spreads really reflect 2 things. One is the default risk that's embedded in high yield, and 2, liquidity risk. And liquidity risk is really interesting discussion. Let's maybe focus on what Carl said about the keg of dynamite that we're sitting on, and that's really because of liquidity. When people need to exit investments in high yield because it's not the standard exchange-listed New York Stock Exchange, American Stock Exchange, it's a dealer-driven marketplace. If you need to exit, it can be quite painful to exit a high-yield security. It's gotten better over time. The market has grown from 200 billion when I started to close to 2 trillion. So the liquidity component is definitely better, but that is a function of when do you need the liquidity. So whenever you need it, it's generally not there, right? If you have it now and times are good, you're supposed to be exiting high yield. So I think that's kind of what he's saying in his message. If you're a hedge fund, right? And of course, he operates a hedge fund, so he's looking to make money every single month. If you're what we call buy and hold investors and you're in mutual funds, that tends to be longer term. You don't need to exit. You've got a 20-year, 30-year horizon. Then volatility of these returns really doesn't concern you as much. But in the hedge fund world, you do, because your clients want month-to-month performance, right? So that's a little bit on that chart. Now let's just skip one more here to defaults. Talked about default rate, and this chart really mirrors what we just talked about in this period of time. Default rates escalate when things are really bad, and this year this default rate is up, and that's mostly the component of energy. Energy is about 17% of the high yield market. So all of this rise really stems from energy companies, which are highly cyclical. So if you were to ask me what's a good, what's the right model for a good high yield company to float, paper to raise capital, and I would say the first one that you want to avoid are very cyclical companies, energy companies, even though they're 17% of the universe. They need a lot of capital for exploration and production and research, and sometimes they drill and it's dry holes, and lots of things can go wrong. It's very capital intensive. On the flip side of that, very stable companies might be a company, let's talk about maybe cellular companies. I'm sure some of you guys have cellular phones, and a really strong business model might be a tower company, cellular tower companies, for example. So those are the types of names that are out there. And just to kind of give a little flavor as to what types of companies enter our market, I'm going to go back to this first chart for a second. Sorry for skipping around, but this is important because when I went back and I talked about high yield, and even talked to my wife about high yield, she goes, well, what really is a high yield? Who are the issuers? So if I ask you for, raise your hand if you've ever been to Las Vegas or Atlantic City. I've got a handful here. Did you win or lose? How about, do you remember the Borgata or MGM Grand or Wynn? All high yield issuers. How about, anyone ever watched The Walking Dead? That's it? Half? That's AMC Entertainment. So, just to put a little light on it, Chiquita Banana used to be a historical issuer. When I started, it used to be Tonka Toys and Federated, and another large one in '89 was RJR Nabisco, a large leverage buyout. So just to, kind of put some flavor to the realities of what companies are issuing high yield securities. Dell Computer and is really what we call fallen angels. So if you're an investment grade entity, those that are rated higher than BBB in the marketplace, right? So we have this whole ratings element to determining what is high yield and what is not. And it's of course either S&P or Moody's in terms of rating agencies. So yeah, Dell is a company that started as investment grade, fell into some hard times, right? And was downgraded by agencies and came into the high yield universe. And we see ample stories of fallen angels. Ford, General Motors, back in '08, for example, they came into our universe. And General Motors, quite frankly, now you brought that up, General Motors is a very interesting story because high yield, back to like the genesis story of when high yield really started, General Motors started raising capital in earnest back in the year 1910. And when they first came to market, they were non-rated, and they had to issue 30-year securities backed by gold to get a 6% cost of capital to raise money to build out plants and equipment and that sort of thing. So it's quite interesting that back then the rating scale was just starting, because in 1909 Moody's initially launched the basic ratings criteria that we're familiar with today. So it's been around. High yield's actually been around a long time. Of course, Drexel popularized high yield in the late 70s, and Mike Milken, and so those are sort of a little bit of the history. So, when I think about what's the career path for you in finance or in business, and I just flip down to some of the things I like to think about, or you should be thinking about in terms of this area of, if you choose to pursue this post your studies, there's lots of ways to go, right? So we have financial analysts, trading, marketing, investment banking, and of course portfolio management. And there's two major schools that you can decide to go on. One is the buy side, which is the area that I've spent 30 years in. And then the other side we call the sell side. Dealers, Goldman Sachs, used to be DLJ, used to be prominent, Morgan Stanley, Chase, and the like, all commercial banks that are distributors of high-yield securities and represent, large clientele, mostly corporations and some of the names I mentioned. So you have two areas to think about. So if you choose the buy side, if you want to go into to be an analyst, these are some of the things I think you should focus on post undergraduate work. Get your CFA. If you work for a commercial bank, go through a credit training program, I think could be very helpful. And this is a very large universe because once you start slicing and dicing the opportunities for you, once you get into the workforce, a financial analyst, you can be what's called a generalist, which means you don't specialize in any one particular industry. Like for me, I studied, spent a lot of time in healthcare and the gaming industries and telecommunications. If you're a generalist, you cover everything. You just cover a little bit of everything. But it's a terrific way to get into the business and ultimately a career path, if you're fortunate, to managing assets and managing money for either a mutual fund or for corporations or other clients, institutions. Now the trading side is also interesting, especially in high yield, because I mentioned earlier it's a dealer market. So it's not like anything you can really grasp intuitively. I'm going to talk a little bit about, I saw you have a lot of Bloombergs here in your school, and you really need to really know the Bloomberg terminal cold, because that's the eyes to the dealer community. It's first and foremost, it's a fixed income platform. It's got everything you could possibly use and utilize for both analytics, price transparency with dealers, and a whole other host of functions that make trading, managing, and analyzing high-yield securities so much easier. It's almost a monopoly to some extent. But you'll need to know and get yourself familiar with the Bloomberg methodology. And portfolio management, I'll just skip right down to the love of my life is portfolio management, because there's two things you really should understand about portfolio management. One is construction. Portfolio construction meaning, how to set up a portfolio in terms of diversification, allocating capital, when to go to cash, those sorts of nitty-gritty things that comprise a portfolio that over time will produce rates of return hopefully greater than your competition, depending on what field you're into. And that leads to performance. And one of the things I remember when I started, I met with one of my senior partners, and he said, Dan, there's two things in this business that I want you never, ever to forget about portfolio management. I said, well, what are those two things? He said, the first thing is integrity. The second thing is performance. And I just looked at him and I said, wow, what a great lesson. Because that, you always hear these things about white-collar crime and greed and fraud and all these bad things you hear from time to time. And the integrity component really stems from a fiduciary responsibility to manage other people's money. So that's really the first thing, and you're held to a high standard to do that. So performance is a byproduct of that, right? Of course, you got to make decisions, and I've made some good decisions, and I've made some bad decisions. So maybe in the Q&A we'll get to some of my good decisions and some of my poor decisions and what I learned from making mistakes. Because most of the time in this business and in any business you pursue, you're going to make mistakes. There's no doubt you will. But it's how you learn and how you kind of bounce back from those elements. So that's kind of a little depiction on where you could go in high yield. And then I'm going to finish with this chart. And this is kind of like the fatherly chart. This is kind of giving kind of just generic advice that if I were in your seat today, what I would be suggesting. And so keep the desire to learn. It's really important, and it'll keep you motivated, right? So if you take your first job and you're like, oh God, I could get it up again, travel 12 hours, and you don't feel very good today about that. If you go every day and you learn something every day, it's a good day. And keep that in your mind. Always want to learn something, right? So if you're in this business, you want to attend industry conferences to kind of peak your knowledge and your skill set. Take continuing ed courses, or you're here tonight, I guess maybe you get a little bit of that, I'm not sure. Learn as much as you can about any company that you go to. And there's so much information out there. When I started, we didn't have, give my age away, but we didn't even have cell phones when I started, right? We had the Wall Street Journal was my only resource. I mean, you've got Google, you've got everything at your fingertips. I mean, you've got so much more in terms of information flow than I ever had. And that's a good thing, right? So learn as much as you can about any company, public or private. Expect to work long hours, talked about that. Ask lots of questions. Ask lots of questions in the workforce. No question's a bad question. And stay goal-orientated. I mean, you have to be aggressive. You really do. And sometimes it's the law of large numbers. So if you work for large companies, right, 20,000 people, and you're one, like, it's right, it's almost impossible. How can I ever climb the ladder, right, with all these people there? But you can do it. So stay goal-orientated, have smaller goals, and you'll achieve over time. So that's kind of the formal presentation. And open it up for Q&A.
So what we will do now is to open it up for questions. Any of you have questions for Dan? I will request you to come up here and speak into the mic. And I am hoping for a good discussion to emerge out of this. While you are thinking about it, whenever you feel like you should come up and come to the mic and speak. While you are thinking about it, I would like to ask Dan the first question. And I want to ask it from the point of view of a student. So we saw a little bit of your understanding of a career, but in your field, could you talk to us about what you actually did? Like, at the junior level, what did you do, and how did you make your way up there, and how did you succeed? What does a high-yield bond trader do at different levels of their career?
Well, that's a multifaceted question. And so day to day. So what do we do day to day? So in portfolio management, when I was on the buy side managing a mutual fund, you're getting bombarded, quite frankly, with lots of ideas to put into your portfolio. And these ideas come from either commercial banks or what we call, salespeople would cover your account, right? So there's lots of mutual funds, and they would call and say, look, have you seen this bond? It's at this price. It's at 100. So bonds, if trade at 100 cents on the dollar, right? That's called par. Anything below that, it's below par, and of course above par. And there's lots of different technical features in bond land, right? So dealers would have what they call an axe sheet. And that's basically, they're acting as agent to sell securities for other customers, right? We're in a dealer market. So I might get a call from my salesperson at Morgan Stanley on a daily basis, and you say, we have, 5 million bonds of XYZ company for sale at 95 cents on the dollar. Are you interested? Now, of course, before I say yes or no, if I say yes, I own 5 million at 95 cents on the dollar plus any accrued interest, that is in that security at that time. So, but I would need to do fundamental research. So if you're in a portfolio management position, you have analysts that cover certain sectors. They're doing spreadsheets. They're looking at financial reports of companies that are public or in some cases private. They're looking at what's called 10Qs, quarterly reports, 10Ks that you can find on company websites. You can source, at least today you can source the SEC.gov, and you can punch in a QSIP, which will identify the security in question, and it'll streamline you right to all the historical financials of the company. Of course, Bloomberg also has this information as well. So you need to put together a financial model of companies, and you need to know how it trades on a relative basis to other securities within the industry. So, for example, if I'm looking to buy, I'll say Wynn Gaming bonds, they're 5 3/8 of 22, and they trade at 104. But Borgata bonds have a 9 5/8 coupon, and they're secured by the property, and they trade at 95. Maybe the yield differential is more compelling to own in the portfolio the Borgata asset relative to Wynn Gaming, both in the gaming sector, that might be unsecured, for example. Right? So that's kind of the thought process from a PM's perspective on a daily basis. I don't know if that helps.
Yeah, it helps a lot.
Other questions?
Students should ask more questions. I always say, when you ask questions, it means you understood what's taking place. You mentioned two themes, which is I liked, integrity and performance. I would like you to comment on my question. It's not in the heart of your presentation, but while I acknowledge that I'm sure you conducted your job with the highest level of integrity, but I believe, and others, that the financial industry is not, does not subscribe to integrity theme. Example, my Chase account saving give me 0.05 in my interest, but my nephew, when he or she, when he in this case gets loan, the Chase charge him 20 times. So Chase in this case goes to performance, but by integrity. So I would like you to comment on this, that the whole industry, I don't think that really is guided by integrity. Thank you.
Okay. So I hope I understand that question. So if I understand it correctly, you're talking about what rates are available to investors, right? You mentioned, a small rate of return for one investment. Maybe that's a treasury security. And then we're talking about what rates are available in other parts of fixed income. Is that what you're kind of asking? Are you asking the difference of returns? Or are you asking about
demand or buying and selling in this case? Whatever you think it's fine with me.
Okay. All right. So in high yield, again, I talked about a dealer community. And I think one of the most important evolutionary changes that has occurred over the last 15 years at least has been the transparency of prices for high yield. And this can be found because it's now, when any trade takes place in the high yield marketplace, it has to be reported, right? It's something called the trace system, right? So any dealers, anything that is traded must be posted and to the trace system. So I think in terms of transparency, in terms of pricing of securities, that's come a long way in terms of providing, I guess it's a loosely defined word, but the integrity of the dealer-investor relationship. I mean, that's probably the best way I can answer that. I'm not sure if I answered the question directly.
So, if I may elaborate on what Mahmoud seems to have been asking, he seems to think that the financial industry has not conducted itself with integrity. And at least that is the public perception. And while you have individual examples of people who stress integrity. Is that generally true of the industry in general? I guess that's the broad frame. Related to that, also I wanted to ask, because we read the popular press, and if you recall, in the 1980s, Michael Milken went to jail and so on and so forth. So this particular high yield sector is associated with high levels of risk. So I guess there is a challenge to sort of seek legitimacy within the financial sector itself. So how does the high yield market do that?
Yeah, so let's go back to the premise of the presentation, which is the first chart about how misunderstood it is. One of the key components, and the way I was able to convey this message about risk reward, is that high yield, because it's kind of falls in between equity and debt, it's delivered a very high rate of return with probably half the volatility of those returns relative to, the Standard & Poor's 500. So right there, if you were to say, Dan, where are you going to put $1,000? And if you were to tell me, do I want to sleep at night, I would prefer, right, and if I want to take a little bit of risk, I prefer the high yield market almost exclusively, because unless you're willing to take volatility, and you can see it in the equity markets. The equity markets, because of all the news pundits and all of the information flow, we tend to get exorbitant volatility from time to time. And so high yield as an asset category has really proven itself, because the growth has gone from 200 billion to 2 trillion, and it's really been blessed by pension funds and insurance companies and endowments and universities, by the way. So it's important to know that the constituency continues to grow, and they appreciate the rates of return given the level of risk and the reduced amount of volatility for taking that investment risk. Look, if you want zero return, right, then you put money into cash, because today's bank environment, put money in your bank, you're going to earn what? 0.5%? Right? So as you go out what we call the curve, if you want to buy a 10-year bond, and we know since this past month or two, bonds they've widened out and they've lost money, right? But if you were to buy a 10-year bond and hold it for 10 years, that's your promised return is 2.5%, right? So if you go out to a 30-year bond, it's 3.5%. So that's kind of your term structure of your risk profile. And equity returns, because of all the level of volatility, you would expect a higher rate of return, right? You might have promised 8, 10, 12, 15%. Small capitalization stocks might require 20%, right? 25% rates of return. It all depends. So I think, to get back to the legitimacy of high yield on a risk-reward basis, clearly high yield, because of that reduced volatility, is far superior an asset category. Yes, sir.
So I guess my question is, before you said that a phone call comes in, they say they have this amount of bonds below par, and do you want to buy it? You said you have to do a lot of research to do it. I'm kind of trying to figure out what the time frame is for you to make that decision, because in the market, that deal is not going to be there all the time. So I'm sure there's some sort of urgency to make the deal, right?
Well, I think you know ahead of time how you want to structure it's a good question, how you want to structure your portfolio, and you see these security prices every day. There's well over 1,000 high yield securities and names in the universe, probably close to 2,000. So there's quite a few. So you see these, what we call daily act sheets, either through Bloomberg dissemination or through phone calls. You know, and you see new issues. So you know what's currently in the marketplace. So if you receive what we'll call it the call, and someone has securities to offer you, you might say, I don't want to pay 95, I'll pay 94 3/4. So you have a little bit of this, we'll call it the open cry, right? And, you can just pass. You say, I'm not interested. And so that's it. It's not any more, it's more black and white than that. So yes, so the market moves, there's a bid-offer spread, they call it, bid-offer. So you're bidding 95, right? And they might be offering at 96, so you have a 1-point spread. It's really a lot for high yield, right? Because you think about equities and how efficient they are with all these new trading platforms, and you know, it's really almost decimal-like, right? So high yield is a little bit more arcane that way, but it typically trades for quarter-point bid-offer spreads, right? But you don't always have to say yes. You have to know what you're buying, right? You have to know what you're buying, right? How it fits into your portfolio.
To know what's probably a good deal at that current moment.
There's no question about it. We do a lot of no's. You know, I used to say no an awful lot, right? So you're looking at deals, you're doing all your homework. There's a lot to read in high yield analysis. It's not like, you know, you get a prospectus. It's called a prospectus, and they've got all the financial background. High yield comes with another element of due diligence, which is known as covenants. So what covenant, not to go too far off the curve here, but what covenants are, they, and what they're called restrictive covenants, they keep companies at bay in terms of how much they can spend at any given time in terms of maintenance, capital expenditures, going out and taking the money and making some, you know, acquisition, or hurting you as a bondholder, because bondholders are creditors, right? We're creditors. If you're an equity holder, you have a participation. You buy one share of Johnson & Johnson, or one share of IBM, or one share of Google. You own it. You're an owner, right? Bondholders are a whole different animal. We come it from the creditor side. So if things go bad and the company files bankruptcy or defaults and misses a coupon payment, right? That equity intuitively flows to us through the bankruptcy courts, right? So that's basically how it works. So there's a lot more due diligence in high yield than I actually believe than in equity because of that component. Yeah.
Yeah, I had a question about callable features with high yield bonds. What are the trends you see in callable features with high yield bonds? Would there be more of that or less of that?
Well, that's a good question. And so embedded in any bond, you have what's known as a call structure. Over time and over cycles, the dealers and the bankers can get a little cute. So typical structure might be a 10-year security with 5 years of what we call hard call protection. So if you have a 8% coupon, it's typically the first year, it's usually half the coupon or maybe 3/4 of the coupon. So we'll call it 104. So in year one, if the company decides, you know what, I don't want to pay 8% to you anymore, in order to do that, I have protection. So they got to pay me 104. So when the markets are really robust, the dealers try to get one over on us, right? They squeeze that call protection down from 5 maybe to 3 years, 4 or 3 years. So that typically happens. So it's not unusual. The trends can be, you know, when even in this environment especially, right? So instead of getting 10-year paper, maybe they'll go for the longest maturity because you have lower rates. So if you're an issuer, I'm going to lock in 6.5 at 10 years. Why not? But in order to float to the market, you know what? I'm going to give you only 4 years of hard call protection. So we're seeing changes like that in the marketplace. It's not always for the best for the buyer. It's usually better for the issuer.
Yeah, because I would have thought if I'm going to assess higher risk in a high yield bond, I want a callable feature that allows me to hold on to the bond for a little longer if in fact it comes out to be okay.
That's right. And there's other elements of call that we didn't really discuss with that question. Some are if the company issues, and they're not public, they issue equity, then you have an equity claw, what's called an equity clawback provision, which gives us the right to give back our securities at a significant premium. Usually it's at 110 cents on the dollar for 35% of the entire issue. So if XYZ company issues 100 million, they go public in the equity markets, 35% of the bonds, right, 35 million will be called to you at 110, called away from you at 110. Not a bad return, right?
No, or like we could do
But-
like a convertible feature or something
Right.
like that as well.
That's right.
Thank you.
Good question.
Assuming the Fed raises rates, what do you see happening to high yield spreads in the next 6 to 12 months?
This is probably the most pivotal question for high yield managers today, right? It all stems to, Fed policy. So before I came on, I was talking to Professor Mir about secular movements in interest rates. So when I started in the business in the early 80s, we had just come off of extremely high inflationary period where interest rates, absolute rates were 10, 12, 13%. And from 1980 through 2016, we've had this major shift downward in interest rates. Major shift. So the question now, post the financial crisis and post Bernanke and now Fed Yellen, is what are we doing? We've had 4 stages of quantitative easing. Where do we go? It's almost to the point where it's a policy error, that we've stayed too low for way too long. So what happens? So one theory is they start to raise rates, right? If they raise too quickly, spreads will be intuitively too tight for the risk in high yield, and high yield will widen out. Just has to because of the leverage component. Most high yield companies are levered 3, 4, 5 times EBITDA or cash flow, right? Some more. So when that leverage component works against you, it works badly against you. It can work painfully badly, especially in a rising rate environment, and we saw that in '94. The question is, if the Fed raises rates now, it's really about the shape of the curve. The market knows they're going to raise, right? We have to get out of this, right? We've got these policies in place now with a new administration. Taxes may come down. Deficits can balloon. But if the rates are starting to go up, what's the yield curve going to do? If the yield curve inverts, and that points to recession, right? Most of the time when we're in recessionary environments, we have an inverted yield curve. Short rates are higher than long rates. If that happens, high yield will really widen out, right? Back to 1990 again. If the term structure just kind of goes parallel, and we keep the steepness of the curve, maybe a little bit of a left to right on the yield curve, that's expansionary, right? If they can play their cards right and maneuver out of this quantitative easing slowly, methodically, and kind of point to the market and let us know, that's kind of been the message, right? They kind of putting this message out there, then we're okay. And maybe it won't be as painful. But intuitively, when we get really tight, that treasury component and that leverage works against you, and high yield will kind of falter unless we stay with a strong economic backdrop. Recessions and inverted yield curves and rising rates are not good for high yield. But if we have a stronger economy, we're growing GDP at 1 to 2%. If we can grow the economy at 3, 4, 5%, despite the fact that we're at full employment, I think high yield will be okay.
So the Carl Icahn interview was from this year? The interview that you showed, was that from this?
That was from December of 15. So actually, that trade, I'm not so sure that trade made a significant amount of money because in 2015, high yield was down just about 5%. So we're still waiting, right? High yield's up 16% this year, generic high yield. And the S&P's up, what's it up, 5.5%?
Size of the high yield bond market is about $1 trillion?
$2 trillion.
2 trillion.
That excludes bank debt. I didn't even talk about the bank debt market, but $2 trillion generic high yield.
So my question is, who are the major issuers issuers of the high yield bonds, and if indeed there is a bubble, as Icahn's interview seemed to point to, what happens if the bubble bursts? Like, what are the implications? What are the broad social implications?
Well, let's see about. Well, forget about the social implications for a second. The access to capital shuts down, right? And that typically happens. Capital markets freeze, no new issues. Companies that are dependent upon capital for growth, they don't get it, right? Slows down. They're certainly not going to, if high yield falls, I guarantee you equities are falling too, right? Equities are falling. Treasuries will come in, flight to safety, should happen. So yeah, bad things happen. Capital markets shut down until we kind of work our way through a period of, stagnation in terms of capital markets. But intuitively, it always comes back. I mean, it looks always bad, and I've lived through every major credit cycle. And they're painful. They're really painful. You never think things are going to get back to where they should be in terms of kind of like the normal distribution of rates, right? But we have a tremendous diverse and durable companies. I mean, we've grown so much in terms of $2 trillion. So it was more when we had, recessions in the 90s, I mean, every company had zero access. But if you were really forced to raise capital now, and it's $2 trillion in size, you could do it, but that cost of capital might cost you a couple hundred more basis points. I mean, if you're forced and you need to raise money, right, then it's going to cost you, right? Now you have free access. Kind of the window is wide open in terms of capital markets, right? And because the rates are so low, the question that this gentleman asked about rates, I think rates will be more of the lever in terms of depicting how high yield trades because of the duration component. Lower rates, more centric on movements of rates. Higher coupons, more centric on equity movements, if that makes sense. So rising rates is really the factor.
Are there any associations or conferences that you would recommend to some of us graduating students to pursue upon graduation? Because me personally, I'm part of NJ Bankers and the ICBA, but that's just for community bankers. So I wasn't sure if there was something maybe more
I think
broad.
It's a great question. I really think you need to be somewhat in the field. So if you're working for JP Morgan, the bank, and you can somehow, they have a conference every single year. Every single year it's in, it's these posh places, right? It's in like Florida somewhere. But yeah, those are kind of the high yield conferences you want to go to. It's a great place to see companies. It's a great place to network, but you got to get there. So somehow you have to work your way into the commercial banking field or an investment management firm to get kind of sponsored, right? That's the right question because it's really kind of invitation only, right? Client invitation only. That would be my only suggestion.
Okay,
Yeah.
thank you.
All right, thank you.
Are there sectors in the junk bond market that you plan to seek out or avoid within the next year?
Okay, so a little foresight. So, me personally, you want to stay in the middle of the fairway. So, and I know the sectors that are more less volatile. What's interesting to me is the potential repeal of the Affordable Care Act, which was passed in March of 2010, and now with the new presidency, he's talking about repealing that. That'll have an impact. It's already had an impact on the equity component of high-yield companies. It'll be interesting to see what happens if it is indeed repealed and the valuation of these securities may become, the contrarian in me says, let's see what happens, right? So if it gets repealed and the valuation of these securities decline, The best way to kind of pursue that, if you like healthcare and you know that hospitals aren't really going anywhere, because the majority of high yield investments are acute care hospital companies, some are rehab companies, some are medical equipment companies. I think you want to go what we call senior in the capital structure, right? Because there's all layers of debt to choose from generically. So if you really want to drill down, you want to go up the capital structure, bank debt, secured debt, and you have senior, and then the sub debt, and you have preferred and equity below you in the capitalization. You want to go senior in the capital structure when things are really bad, right? Unless you want to take that equity risk profile, which can backfire. But intuitively, you want to go to the safest spot in a sector that's out of favor. And energy was a great example. Energy this year in high yield, generic high yield's up 16%. Energy is up over 40%. Complete recovery. There was quite a bit of defaults in energy, but the hockey stick recovery, because oil recovered, we got down to like $30 for West Texas Intermediate. I think it even broke 30. Now we're back up to $50 range. So it's a commodity-based sector. It's not my fan favorite because of the vol. But I think healthcare has an interesting potential going into 17.
Okay, so my question has two components. When did you feel that you were ready, and what prompted you to diverge from the other companies that you worked for and start your own?
Yeah, so it was easy early on, right? So I was motivated by trying to be successful, right? So money's always a great equalizer, right? Making $287 a week didn't really pay a lot of bills. So so every stepping stone along the way, you're comp motivated to some end, right? I'm making $20,000, I want to make $30,000, so you kind of climb the ladder intuitively that way. But the other side of it is when you find something that you think you're really good at and you're passionate about, the money is going to follow. It's almost a byproduct of what you do and what you love, right? If I just went around looking for money, it's going to be a little shallow. I know that sounds weird, but it's kind of shallow at some point, right? At a certain level. So you really want to find something that you want to wake up, go to, and work, and continue to work. Because look at some of the leaders, we'll call it, in the business, right? You got Warren Buffett. Is he retired? No, not really. He's pretty rich, right? Carl Icahn. The list goes on and on. People do this because they love it. They really love it. So what prompted me to kind of move and then ultimately start Stonegate Capital, and then I merged Stonegate with Global Credit, was kind of the passion for the business. Right? Do it for on your own, right? Have ownership control. So I think that's a very large component of it, right? So money is going to follow, almost in any field that you choose. It doesn't have to be finance. It will follow, but you have to give it time, and you just have to be willing to work hard and make not a lot in the beginning, right? And that's okay too, right? My son's actually, he's probably listening to this, he's probably going to cringe when I say this, but he became a teacher. Great, right? He was a history teacher, and now he's in administration, and he's working his way up, but he loves what he does. My other son became a physical therapist, and he spent 7 years in school. He was a kinesiology major and just got his first job, and he took the first job right away. He goes, "Dad, what do you think about this?" I said, "This is your field. This is your path. Right? You don't have to follow my path. But if you love what you're doing, the money is going to follow intuitively. Right?"
Thank you.
Last question.
Oh, yeah. Last one for you.
What are some methods or models that you use to value high yield bonds?
Yeah. So I'm a pure fundamentalist at heart. So what does that mean? I'm not looking at the technicals, right? So you have technical analysis, you have fundamental analysis. So fundamental analysis is basically, getting down and dirty with cash flow statements, income statements, balance sheets, all the nuts and bolts of fundamental analysis, right? Learning the capital structure of the company, doing a spreadsheet, modeling it out 3 years. Some people like to go 5 years. Why 3? 3 is important. It's kind of the old, what I used to call the 3-year rule, because in 3 years, you're going to know if the company is going to default or not, right? You're going to know, right? It's either you're kind of closing in on hard call protection, the company continues to come back and has the ability to refinance over an economic cycle. You know what companies work and what don't work. So modeling out is very important. So I'm a fundamentalist, right? That's basically what you need to know. What's the free cash flow of the company? Can they pay back their debt with that free cash flow, right? Because you've got a whole host of obligations, right? You've got cash flow, you've got to pay your interest expense on the coupon, right? If you have bank debt, there's something called amortization schedules. You've got to pay quarterly payments on your bank debt, right? You've got maintenance capital expenditures. So if you're a casino operator, you've got to change the carpets every once in a while, right? Change the lights, put new slot machines in, those sorts of things, right? So all of those elements in the cash flow analysis come into play. So if you're cash flow negative and you can't meet all these expenditures for operating your business, you're not going to pay off your debt.
Can you elaborate on some models that you use?
So again, back to just basic Excel spreadsheets, right? Basic work. Yeah, I know what you're getting at, but yeah.
Anyone here? Yes, John. Go ahead.
I have a question first and then a forecast, and I'd like you to comment on it. There's a conflict of interest, of course, because rating agencies charge the companies which they rate. What is your recommendation to address that issue, which is a big problem, as you know, number one. And number two, I forecast interest rates probably will rise substantially, not probably, will rise substantially if the new president pursues the campaign promise of spending more money on infrastructure and lowering taxes at the same time that the Fed is pursuing a rather contractionary monetary policy. It's certainly the Treasury will crowd out private market.
Yes, okay, good question. So number one is the rating agencies and the conflict of interest, because they're paying clients to gain the rating and then they're coming to market, and we have to make judgments on the ability for those companies to meet their debt obligations. So here's the thing. It's a free market, right? So I'm a free market capitalist. If a company comes to the new issue market and it's rated single B, which is kind of right in the middle, right? You've got triple C, B, and then double Bs, and so you're right in the sweetheart spot of being rated. It's really the onus becomes back to the investor. There's really no two ways about it. It's the same question if you want to buy an equity that trades at 30 times price to earnings, and we'll just use J&J for example, right? It was trading at 25 times forward earnings, and the market's at 16 times. But you decide, you know what? I like J&J. I'm taking the risk. You own it. You take the risk. Same with the rating, right? Single B, you're getting paid 8.5%. The market's at 6.5%. That 200 basis points is enough for taking a single B credit risk. The agencies become off the hook because they don't have any capital at risk, right? So I'm an investor, right? So all these variables have to come into play. Or it's just not the rating agencies is one component of credit analysis. You've got some of the work I mentioned before, cash flow, predictability, balance sheet structure, right? Those sorts of things that all come into play to make an assessment on what's a good credit and what's not a good credit, right? So the agencies, they get a pass. They really do. They get paid, they get the pass, they get paid to do what they do. They're not going to be right all the time, right? They're definitely not going to be right. So if I really think it should be warranted a B+, right, we'll have to see. We'll have to see as quarters progress and how the financials play out. It may, in fact, be misrated. And that might be to my advantage if I'm good enough in terms of my credit skills. As far as interest rates in the current administration, look, I'm a supply sider, so I believe wholeheartedly that if rates start to rise and the policies of simultaneously a reduction in the corporate tax rate from 34% to 15% to make corporations more competitive, the question becomes, how quickly does the Fed raise rates, and does that slow down the economy at the same time when we're reducing interest rates, which should in fact lead to more free cash for companies, for corporations. So I look at it this way. I'm paying the government 35% to manage all other resources and services that I need as a taxpayer. If corporate rates go down from 35 to 15%, right, that shift and that gap, that 20% gap, goes from the government back to the corporation, back to free market. So what can the company do? Right? What can they do? Hire more, build more infrastructure, to your point, right? That would be, otherwise it goes back to shareholders in the form of increased dividends, stock buybacks. But I'd like to see all of this deferred infrastructure, shovel-ready thought process play out. I can only look around where I live. I see roads, tunnels, bridges. I can only see around my environment what really needs to be done. And I think there's quite a bit that needs to be done, right? So this might be the stimulative policy that can get that going, right? And the market certainly has blessed it so far, right? It's all about the execution of these policies, right? So if the new administration comes in and they sign a bill, they control the House, control the Senate, let's lower corporate tax rates, right? That's what the market's anticipating. We have to see if that can get executed in the first 100 days of the new administration. Aside from that, this is just a personal view, but risk-based capital, for me, if any job that you're in and you're getting paid, you get taxed, right? But if you take that after-tax dollar and you decide, I'm going to put $1, I'll go back to J&J because I said it a few times, and you buy one share of J&J at $113 a share, and it goes from $113, it splits, goes to $140, and it paying you dividend over time, and then you decide to sell it. Do you think you should be taxed on that risk capital? To me, I earned it. I worked for it. I don't want to get taxed another 20% short-term capital gains tax or 15% long-term capital gains tax on money that I've worked hard for. And by the way, I'm taking the risk. So in a free market, way I think about things is that should be a zero, right? We should not get taxed on that. It's double taxation. Again, there's a little deviation from your question, but it's simultaneous with risk-based capital and lower rates. So I think lower rates are stimulative and should be stimulative to the economy.
I think this is as good a time as any to call an end to the proceedings on my behalf and on yours. I would like to thank Dan very much for his...
Thank you. My pleasure. Thank you.
Dan will be, I guess I'm speaking for him, but he will be quite generous with you if you feel like reaching out to him after the talk, and you can email him, and I'm sure that he will be very happy to mentor you. Those of you who are interested in a career. Now, when people speak so eloquently with a lot of technical language, you might feel intimidated, but this is stuff that I'm sure he learned on the job. And so many of you might be interested in reaching out to people like him. Please feel free to do so. I'll be happy to provide you with his contact details. Thank you very much, and you have a wonderful night.
Thank you.